Welcome to the IFRS number 18, Presentation, Disclosure and Financial Statement. Now, this standard really replaces the old IAS number 1, Presentation of Financial Statement, which existed for more than 50 years. Now, the IASB decided that there are 3 particular issues that within the IFRS number 18, i.e. to make them quite clear, which differs from what we've seen in the IAS number 1 before. Now, firstly, we will be going through the grouping of information. Now, what do I mean by grouping? Is when we organize information, which means it's our thought or thinking process. So in other words, we will need to decide whether or not we should aggregate the information all together into the same category or to disaggregate them, which means to show them line by line. So an example for this, for example, we've got the apple and banana. We aggregate them into the category called fruit. And this is what I mean by aggregation. This aggregation, on the other hand, is that basing on the fruit category, we separate the apple and banana on a line-by-line basis. So after you look at that, we'll be looking at something called the management defined performance measures, or the KPIs that are coming from the management imagination. So in other words, if any sort of ratios or any sort of figures that are coming from the particular IFRS that would not be falling into the management defined performance measure. So for example, a good example for this will be gross profit. Gross profit is never an example of the MPM. Of course, the IASB decided to make this super clear is that it will need the MPMs to be reconciled back to the IFRS profit and subject to be audited. So this is so important, and we will detail that later on. And finally, we will be seeing the subtotals in the P&L. So in other words, we will be introducing the new format of the statement of profit and loss, which would be an example of the primary financial statement. And finally, we will be looking at when should we adopt this standard. Now, first things first, let's go through the chapter 1. It's all about the aggregation and disaggregation of the information. Now, in this chapter, we will be answering 4 particularly important questions. Firstly, as I said, whether or not the transaction would be going into or presented onto the face of the financial statement. Alternatively, simply disclosing that in the disclosure note. Now, just to give you a flavor, is that if it meets with the useful structured summary, or short for USS, what we need to do is to present this one, or present the transaction directly onto the face of a primary financial statement. Now, the primary financial statements will include the SFP, P&L, OCI, SOCSI, and even the cash flows, which did not change or carry this forward from the IAS 1 accounting standards before. Alternatively, if the transaction itself is only to be material, which means meeting with the materiality principle, which we can find it from the practice statements number 2, making materiality judgment. So if that's the case, if the information is only to be material rather than meeting with the useful structure summary principle, we only need to show them in the note. Now, in order to meet with the USS, or the useful structure summary principle, you will need to meet with these 3 criteria. Firstly, in practice, I will need to assess the frequency of the transaction. For example, if you're operating in a retail bank, that the retail bank will have the interest revenue each and every day. So this means that the interest revenue would be an example that driving its profit up So because the transaction happens daily. So if that's the case, then it meets with the first criteria. It really provides an understandable overview of the business, what would be the key economic driver. And then from the investor's point of view, we would like to compare the interest revenue of this bank with the competitor to see whether or not our performance is better. Alternatively, we would like to compare the interest revenue with the past of the same bank and to see whether or not the performance has actually been improving over the years. So which means that the second criteria is that we will need to make comparisons for that. And thirdly, it's very important that the investor will be quite interested in that, which means that if you were to show this area or the transaction onto the face of the primary financial statement, you will need to make sure that the investors is interested in what's going on. So for example, if I'm the investor, I can see that, okay, the company only gets the government grant, but only for this particular year. If you were to show that separately onto the face of the P&L, for example, I wouldn't say that the investor will be quite interested in that too much because that transaction is not happening quite frequently from my perspective. So this is why if that area cannot attract investors' attention, in order for them to seek additional information in the disclosure note when they see the highlighted figure onto the face of the primary financial statements, I wouldn't say that the third criteria would be met. So therefore, in order to meet with these three criteria, you will need to see whether or not the investor you're bringing onto the face of the primary financial statement would really be useful to the investors and even to the creditors, of course. In other words, meeting with the USS would usually be meeting with the materiality principle in practice in most circumstances. Now, let me detail the materiality principle. In order the item to be material, I would like to summarize the principle I used quite frequently in real life is that I would need to see whether or not the transaction would be the big money to the primary financial statement. So an example for that would be that if the item is more than 0.5% of the total revenue in the P&L, and of course that would be material by amount, which means that we will need to consider the quantitative factors of that. However, this is not enough. So think about it in this way. We've got the fintech company developing its own AI platform, spending, let's say, $30,000 on that. Although the amount is not big money, however, it did tell a big story. The reason is that it really considers the qualitative factor in that. Because think about it in this way, that the AI platform or the artificial intelligence platform will be closely linked with the fintech company's strategy. So in other words, that it's meeting with a qualitative factor in terms of the internal stuff. Another example I can give you is that perhaps the retail bank holds certain amount of cryptocurrencies. So for example, the Bitcoins. Of course, from the external regulators' point of view, they do really care about the risks related to these cryptocurrencies. So even though the amount will not be a big money to the business, however, from a qualitative point of view, it may be material because we are thinking about the external factors. So in other words, when we are determining whether or not the item will be material, we are looking at from the quantitative point of view, which means the big money, and qualitative factors point of view, which means that whether or not this event will be related to the internal operation of a business, including the fraudulent transaction, and from the external major stakeholders' point of view. Okay, so we need to provide the balanced view on that. All right. Now, after you look at the first question, where does the transaction go into? Either in the primary financial statement or in the disclosure notes, well, it's time that we will need to do a quick question on this. For example, we've got the bank, we've got the fee income. Do we present that separately onto the face of P&L? Well, I think the answer would certainly be yes. The reason is, I would say that it meets with the useful structure summary principle. There's quite frequent transaction happening daily within the bank to get various fee income. For example, the incomes charged when I manage the wealth of different clients. At the same time, it meets with the materiality principle, because as you can see, that it accounts for more than, it's like 40%, okay, more than 0.5% of the total revenue. Now, after you look at this particular question, well, the next one in the chapter 1, we'll need to decide whether or not we will aggregate the information, which means to combine them into the same category, but we don't use combine, these technical words, in the IFRS number 18. Alternatively, we just disaggregate the information on a line-by-line basis. Now, to determine whether or not we should aggregate or disaggregate the item, we'll need to see three things. Now, if the item shares similar measurement, risk and liquidity, we should aggregate them into one category rather than separate them out. Now, the best way I like to show you is that think about the retail bank. It holds equity instrument, which means it bought shares in other companies. Now, bought shares in other companies and it valued them at fair value through P&L. So in other words, that the market price changes for those shares, we directly put them into the statement of profit or loss. At the same time, the bank holds debt instrument. So in other words, the bank lends money to others. And of course, expecting to collect interests and the redemption value from various customers and measure this financial assets at amortized costs. So if that's the case then, do we need to present them as separate line items? Which means that can we simply disaggregate the items? Well, the answer is certainly yes. Well, the reason is, I do believe that any one of those characteristics will not be similar among equity instruments and debt instruments. The reason is, firstly, that one is measuring using fair value through P&L and one is measured at amortized costs. They have different measurement bases. At the same time, their risks are different. One, we are caring about the market risk, for example, that the share price will fluctuate each and every day. Alternatively, for debt instrument, we are considering more of a credit risk, i.e. that maybe we can't receive money from our customers. From a liquidity point of view, I would say that in terms of share price, it will fluctuate every day. So this is why in terms of liquidity, we can only realize the investment into cash when we sell it. However, in terms of a debt instrument, I would say that more stable cash flows in terms of a liquidity, which means cash flows, can be obtained. All right? Because we will be receiving, most likely, the fixed interest income in each and every period. So which means that, okay, so neither of those would be quite similar with each other. So I would say that under financial assets onto the face of this statement of financial position, I will need to show them separately. Investment in equity instrument and investment in debt instrument, rather than simply telling the investor, so we'd like to combine all of these or aggregate all of these into a financial asset category. We never do that. Okay, so that's the idea. Now, let's answer the third question, okay, in this chapter about the aggregation and disaggregation. Now, the IASB did specify the disaggregation of the operating expenses, in particular in the P&L. Now, when we are preparing for the P&L, so nowadays it would be quite in line with the statement of cash flows showing the OIF, which means the operating cash, investing cash, and financing cash, which means that when we are showing the performance, we are also using the OIF. But I will need to show you the new P&L format in a second. But now let's focus on the operating expenses. Now, when we are preparing for the P&L, we can include the cost of sales figure. Now, if you decide to do that, we are saying that we are using the by function way to prepare for the P&L. The advantage of using by function way to prepare for P&L is that it can better enabling the investors to calculate margin on that. At the same time, in the P&L, that the IASB did allow you to prepare for the P&L by the mixture of by function and by nature. Now, the advantage of preparing for the P&L using by nature way is that it is very good for prediction purposes. I mean, when investors looking at, for example, goodwill impairment losses, is absolutely fine there. So we can observe different goodwill impairment losses in each and every period. We can then base on different goodwill impairment losses in the past and to predict the goodwill impairment losses in the future. And of course, the mixture of by function showing the expenses in each of the departments, for example, cost of sales, like within the production department and even the other departments' costs, and even the by nature mixture of those will be absolutely fine there to provide useful information. However, the IASB did say that if you were to prepare your P&L using by function way, you will need to disclose at least these 5 elements in the note, which means disclosing the items by nature in the note for these 5 items, including your depreciation and amortization related to your PP&E, related to your intangible asset. At the same time, you will need to consider whether or not these two would be subject to impairment. And of course, for some of the companies which may not have inventories, you can ignore that. But if you've got inventories, so please provide the write-down of that as well, potentially. And even the employees' benefits, including the pension schemes, they will need to disclose that in the note, okay? Which means that you will need to disaggregate them. But this is not enough. According to IFRS number 18, it said that if you were to disclose the total depreciation, because it's so specific, which means that this is the by nature way, you will need to trace it back to which department. So for example, the total depreciation, let's say that would be $10 there. So $3 go into cost of sales, $5 go into R&D, and then $2 goes into the admin department, for example. So total would be 10 there. And of course, you also need to state the comparative as well for comparison purposes. Okay, so this is an example. Now, according to IFRS 18, it said that for the final one, is that if part of the expense, so let's say that $10, $8 has been expensed into the P&L as the expense, however, the remaining $2 has been capitalized as an asset. I mean, when we capitalize the expense, so in other words, we would like to defer the expense to be recognized in the P&L. But currently, we capitalize it onto the face of SFP as an asset. Now, if you were to capitalise that expense, the IFRS 18 said that you will need to provide qualitative explanation, which means that you simply say to your investors that you capitalised part of the expense. However, the part of the expense by how much? Is it $2 or $3? Well, in practice, that it would be relatively difficult for you to estimate that expense because that really requires lots of human judgment. So, for example, according to IAS number 38, intangible asset, when we are determining the capitalised development costs, it would be relatively difficult to determine all the expenses to be capitalised in one go. And of course, we will need to see whether or not we reach the stage that we've got the market that we can sell the improved products, or the way that we can utilise that improved product in our own business. That really requires lots of human judgment. At the same time, for example, if the capitalisation work is done centrally by the centralised treasury function, it would be relatively difficult for your divisions to obtain the data source. So this is why in order that we relieve the cost burden on most businesses, we do allow that they simply disclose the qualitative explanation with our numbers, that's saying to the investors that part of the expense has been capitalised, and that's it. Now, of course, here's the question for you. A bank develops its own risk analysis platform and capitalising the development costs. Some of the employee benefit expenses has been included in the intangible asset. So do we need to say that in the note? Of course, the answer is yes. We simply say that part of the expense has been capitalised, and that's it. Now, I will say that the final question for the chapter 1, all about the aggregation and disaggregation, is the changes to the statement of cash flows. Now, before this standard, according to IAS number 7, statement of cash flows, when we are preparing for the statement of cash flows, the starting point will certainly be using the profit before tax. However, nowadays, we'll need to start with the operating profit rather than the profit before tax. And of course, I will show you exactly what does the new P&L would look like here. And of course, just to give you a flavour, is that the operating profit will never include the income from associates or joint venture. Of course, when we are dealing with the interest received, we receive interest. Why? The reason is we invested the debt instrument. That would be an example of a non-current asset, which means the financial asset. Of course, within the non-current asset, that should be the investing cash flows in the statement of cash flow. So therefore, that the interest received, again, same as what we've seen before, we include that in the investing cash. Interest paid nowadays is different. Interest paid will need to include in the financing activities, because we pay money, we raise finance, for example. But dividend received and interest received still be the same in the investing activities. Dividend paid still the same in the financing activities. But here, if you can see, the title here is that entities without specified main business activities, which means that without S, M, B, A. Oh, what do I mean by SMBA or specified? Or those business activities be specified by the ISB. I will say that if any given businesses, their activities will be primarily responsible for investing or providing finance to customers to earn interest income. So if that's the case, then no specified main business activities, and that's it, which means that normal businesses. However, for some of the entities that with specified main business activities will be related to the insurance company, that collecting your money and to invest in somewhere else, alternatively, bank. So if this is the case, then I would say that the dividend paid, same as what we've seen before, financing activity. However, for the interest received, paid, and dividend received, it would be included in the original P&L activity category. Just to give you a flavour, for example, for bank, the main activity will be to receive interest income. And therefore, the interest received will certainly be included in the operating section there. And we'll detail that later on. Now, this is the first section, okay, of the IFRS number 18, and I look forward to seeing you soon in the next one. Bye-bye.
APC, accounting for your future.